Happy Friday. I hope everybody had a great week. My name is Emily and I'm here for another FAQ Friday. This week I'm going over the frequently asked question of rate locks. What is a rate lock? Why do I need a rate lock? What is it for? What does it benefit? With rates changing every single day, a lot of people want to get that rate that we quote you the day of. Well, that's what a rate lock is for. What is a rate lock? A rate lock is when your loan gets locked into a specific interest rate, which is going to protect you if the market were to change. If your loan officer locks you in at a 4% rate that they quoted you and rates get way worse tomorrow or next week, you're locked in at that 4%. So no matter how bad rates get, you're going to have that 4%. Now, the opposite side of things is, well, what if rates get better? If rates get better, most brokers, most lenders will allow you to float your rate down. So if you locked in at that 4%, but rates get a lot better, you can float your interest rate down to maybe a 3.875. It really just depends. That's something that you need to call your loan officer and talk to them about, because every lender may have a different guideline behind it, which can play a factor into how much it'll buy it down and things like that. So talk to your loan officer, but the main point is if rates do change, it can float it down, but if they get worse, you're locked in and you're safe at that locked in interest rate. Rate locks come in different terms. You can have a 15-day rate lock, a 30-day, or a 45-day. Those are the three most common that we see. A lot of times your loan officer will be able to guide you and say whether, okay, well, if the market's not really changing and it's just kind of staying flat, or maybe it's slowly getting better, we'll hold off on locking. Once you get closer to your close date, we may be able to just lock you on a 15-day or a 30-day. If rates seem to be getting a lot worse, they may lock you in on a 45-day, because that's the safest way and that's the easiest thing to protect you as a buyer and protect that interest rate for you. Now, why are they different? Well, they each cost a little bit different. A 15-day rate lock may give you a little bit better pricing than a 30-day or a 45-day, which is why if the bond's not changing and the market's staying pretty flat, why lock in on a 30-day if the 15-day will get you a little bit better pricing and the market's not changing? So that's where that benefit comes in there is, like I said, 15-day, a 45, and a 30-day all have a little bit different pricing. The shorter the locked period, the better the pricing. One last thing is, when your loan is locked, you have to close within that time frame. So if you have a 15-day lock, you have to close within 15 days. If you have a 30-day lock, you have to close within 30 days. Meaning, if your docs are getting sent in, getting submitted to underwriting, once that loan is locked, you really got to be on top of everything and make sure you're being fast and getting whatever the lender needs back. That way you don't miss out on that lock. If the lock expires and your loan isn't closing, you're now subject to worst case pricing. That lock's gone, that rate is gone, you still haven't closed your loan for whatever reason. Now you're into worst case pricing. So once your loan is locked, be sure to be on top of everything, getting all your docs into your lender, and that way you can close on time and not miss that lock. Again, when it comes into locking, always talk to your loan officer. They'll be able to be the one to advise you on what's going to be the best option based on what the market's doing, what your loan looks like, and all the different key factors that play into your particular scenario. But main thing is, for all loans, you do get to lock in that rate to make sure it's safe. That's about it. If you guys have any other questions, drop them below, and have a great weekend.